Hi, good afternoon, everyone. Thank you for joining me. Once again, this is Ian Gendler, Director of Research at ValueLine. Today, using ValueLine's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, as mentioned, we have allotted time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on ValueLine.com and our YouTube channel within the next 48 hours. To start, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As a jumping-off point for our stock search, let's start with an overview of the economic situation, as well as the ValueLine Research Department's view of the stock market. This is especially important since the market has been quite volatile of late. The following content was prepared by Harvey Katz, ValueLine's chief economist. Interest rates are a concern once again, which is not all that surprising given that abrupt increases in borrowing costs often draw the ire of investors. Until very recently, by comparison, equities had been supported by low and stable rates as the Federal Reserve sought to put the economy on a secure footing by keeping the flow of money easy and inexpensive. But now, strong GDP growth and somewhat higher inflation have pushed rates higher, with yields on the 10-year Treasury notes hitting a 7-year high earlier this month. There is some justification for these worries, as rising yields, the 10-year Treasury note recently hit 3.25% before easing back, provide some competition for stocks. Also, the higher borrowing costs have made it more costly to take on debt. The costlier funding likely will curb loans to businesses and pare spending on retail purchases and houses. Indeed, September already saw softness on both fronts. Even so, we sense that the recent drop in stocks was overdone. First, the business expansion appears to be well grounded to handle a modest rise in interest rates. Also, the latest consumer pricing data suggests inflation will not push sharply higher anytime soon. Finally, a key market support, rising corporate profits, is securely in place. All told, this earnings season looks to be another solid one, with healthy percentage increases, boosted in part by tax cuts, likely to be the norm. In fact, it was a succession of upbeat reports from corporate America last week that helped to partially counter the earlier strong statement by the bears. Then there are the midterm elections. But assuming no dramatic shift in the direction of economic policy, Wall Street should muddle through, with sizable gains or steep losses unlikely. On balance, therefore, we are cautiously optimistic, with neither the uptick in interest rates, the uncertain outlook for oil prices, the worsening trade risk with China, nor the occasional global dust-ups, such as with Saudi Arabia most recently, likely to upset the apple cart on a long-term basis. In sum, we believe the careful accumulation of quality equities remains a prudent strategy. I think Harvey's views are on the mark, but I'm going to take it one step further. Over the past several weeks, we have witnessed material price swings in the market and frantic trading. For instance, just yesterday, the Dow was down more than 450 points, but paired a great deal of those losses by the close. As such, for today, I want to focus on the most stable stocks under Value Line coverage. Thankfully, Value Line provides the tools and information to incorporate factors such as this into an investment strategy, which we will tackle in a few moments. For now, however, please note that we are currently on our homepage, www.valueline.com. On this page, you can access, free of charge, daily market commentaries, as well as general interest articles that are written by our analysts. Examples of such content are analysis of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. On that note, as mentioned earlier, we are currently in the heart of earnings season, so I encourage you to regularly visit our website to stay up to date when it comes to the Dow components' quarterly releases. Just this morning, Boeing reported, and after market today, we will hear from Visa. I'm now going to sign in with my username and password. After entering my credentials, I'm taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our home pages for our monthly stock selection services, as well as our investors tools. As you know, the point of this presentation is to find a stock to buy right now, so let's go to the screener and get started. This tool can also be found via the Find Ideas tab at the top. Subscribers have access to more than a dozen preset screens, as well as almost 50 data fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. I'm now going to run a screen with the information we have discussed, as well as add some other worthwhile variables. The goal will be to find equities that are the most stable, offer compelling dividends, and are expected to perform well over the near and long terms. Obviously, let's start with stability. Personally, whenever I'm conducting a stock search, I typically prefer to remove risky equities, and there are numerous risk and volatility measures, but we recommend Value Line's proprietary safety ranks. The safety ranks measure the total risk of a stock and are arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. This should be particularly relevant in today's market environment. Thus, let's focus on stocks ranked 1. So I just click on the field and click on the 1. These are the most financially sound companies, and their stocks have a history of relative stability. It is worth noting that of the nearly 6,000 stocks currently in our database, only 130 or so garner this top rank. For those that don't know, our safety ranks are derived from our financial strength grades and our price stability scores. For more information here, I recommend a read of our ranking system guide, which can be accessed via the investment education section on our site. And that's right up here. On top of safety, we can add another defensive layer by considering dividend yields. As most of you probably know, dividend-paying stocks tend to not fall as much as the broader market during bearish times. The current median dividend yield for the 1,700 stocks that we track in the Value Line Investment Survey is 2.2%. This figure is updated and published every week on the front cover of the Summary Index. So let's make 2.2% our low threshold. I also want to mention that this yield encompasses our research department's estimates for the next 4 quarters of dividend payments. Thus, this is very much a forward-looking yield. This is an important distinction since other research houses, screeners, portfolio software, and data providers commonly utilize a trailing dividend yield. We feel our calculation is simply more useful. So I put the 2.2% in the from box and click filter. Now let's focus on performance. I want to isolate stocks that Value Line expects to outperform the broader market over the near and long terms. For the short term, I'm going to use our popular and time-tested timeless ranks. Like safety, the ranks are from 1 to 5, with 1 being our top rank. 1s and 2s are expected to outperform the market over the next 6 to 12 months. 3s will likely mirror the market, while 4 and 5s may lag. A great deal of information on the ranking system for timeliness is available in our guide, but I should mention that although the calculation is purely quantitative and proprietary, the system is based on a number of factors including earnings results and stock price action. So let's add the 1s and 2s to the screen. Okay, down to 21 results. We're getting close. And if you want, we can take a quick peek at the stocks that have so far met our criteria. My last field will focus on potential stock price appreciation over the long term. This is a good time to mention that for all 1,700 stocks in the Value Line Investment Survey universe, we create 3 to 5 year financial projections. I want to highlight that Value Line is one of very few research houses that provide financial projections that far out. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. Using these values, we then create a target price range for each equity. For the final field, I want to tap into this and include the projected 3 to 5 year annual total return percentage, and I'm going to focus on the low end of the range to be conservative. I'm going to use 8% as my starting point, which is similar to the historical annual rate of return for the major stock market indexes going back decades. For this, I have to type in 0.08 and click filter. 7 results, which is nice and manageable. According to our criteria, these stocks are the safest, offer worthwhile dividends, and are expected to perform well over the near and long terms. Several of these may well fit nicely in your portfolio. However, only one can be today's stock to buy right now, and while preparing this presentation, I evaluated each one and discussed their prospects with my team of analysts. All told, I am recommending Verizon, ticker VZ. Before I go any further, I want to point out that screens can be saved and revisited later on by utilizing the button at the top. Let's now get some more information in regard to Verizon. Clicking on the company name will take us to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden so you can create your own customized report. Once you alter the presentation to your liking, you can save your changes from the horizontal sliding action bar. The next time you come to this report, it will look the way you set it up. You can also apply those changes to other stocks. I assume all of you are familiar with Verizon, but I want to provide some details about the company. This information is provided in the business description module. It is a diversified telecom company with a network that covers a population of about 298 million and provides service to nearly 98.2 million. It has a wireline presence in 28 states and Washington, D.C., a wireless presence in 50 states and D.C., and operates in 19 countries. That said, importantly, the bulk of Verizon's revenues are derived here in the U.S. This may prove beneficial if trade and tariff concerns persist. Moving on, how has Verizon stock performed of late? From the valuation module, I can quickly pull up a stock chart. And the yellow line is its stock. As you can see, Verizon has performed quite well over the past few months. I now want to quickly highlight our classic one-page reports, which are available for all digital subscribers. They are available using the button on the top right. This report was from a few weeks ago, and if you follow earnings season, you will know that Verizon reported quarterly results yesterday. When important information and/or changes in our analysis occur in between our full reports, we publish supplementary reports. For Verizon, of course, we recently published a lengthy one, which I'm going to show you now. This will get everyone up to speed in regard to what is going on and will provide reasons why I'm recommending the stock today. Going back to the dashboard, the supplementary reports can be accessed from the link here in the quick links. As you can see, we've had a busy few days with earnings season, and yesterday we put out the Verizon report. So simply clicking on the link will provide the commentary on the right. There's also a printer-friendly version if you'd like to take advantage of that. Per editorial analyst Kenneth Nugent, in the first paragraph, he sums up the release. Verizon reported third quarter earnings of $1.22 a share, 2 cents above our estimate, and an impressive 24% jump relative to the year-ago result on a 2.8% top-line improvement. And investors have taken notice of the company's good fortune, with Verizon stock up about 3% on the news. As mentioned earlier, the market was deep in the red for most of yesterday, and VZ bucked that trend. This is another example of the stock's stability and resiliency that is captured in its top safety rank. Looking at the September quarter in more detail, the Verizon Wireless division, per usual, fueled results. The business achieved a 6.5% increase in third quarter revenues, the fourth time the company has reported year-over-year wireless revenue growth in 2 years. What's more, the percentage of phone activations on device payment plans was 83%, compared to 78% in the same period last year. In addition, service revenues, which had been declining earlier in the year, grew 0.8% year-over-year in the September quarter. VZ Wireless added 515,000 retail postpaid net additions during the interim, compared to 603,000 this time last year, bringing Verizon Wireless's total number of retail connections to 116.9 million, up 1.4% year-over-year. Also, the company is going through some changes. In fact, Verizon looks a bit different than it did this time last year. To wit, in late June, the company named Chief Technology Officer Hans Vestberg as its new CEO. Mr. Vestberg joined Verizon just over a year ago after a 6-year stint at communications equipment maker Ericsson. At Verizon, he headed a group responsible for building out the company's fiber network infrastructure, and his promotion became effective August 1st. Hence, it comes as no surprise that the company recently announced that it will begin to roll out its next-generation 5G network during the final stanzas of this year. In closing, Mr. Nugent had the following to say. Verizon is on track to report 2018 earnings of about $4.65 a share, with a modest increase likely in the cards for next year. This blue-chip stock remains a good choice for conservative investors thanks to its impressive dividend yield, highest safety rank, and alluring capital appreciation potential through the early years of the coming decade. All told, today, Value Line is recommending Verizon, ticker VZ, as one stock to buy right now. Now, briefly going back to the PDF, I want to point out that our 3 to 5 year target price range is 80 to 95, suggesting that there is plenty of room to run for this rather conservative choice. Before I move to your questions, I want to quickly highlight one product that Value Line offers that may interest those that found today's strategy for finding stocks appealing. We offer Value Line Select Dividend Income and Growth. It is one of our premier monthly stock selection services that, as the name suggests, recommends stocks that offer worthwhile dividend yields and dividend growth prospects. The recommended equities tend to be large, mature companies that have a history of relative stability, profitable operations, and the financial strength to generously fund dividend payouts. Each month, we publish a detailed report recommending a top selection, as well as 2 alternative stocks for subscribers' consideration. Once we recommend a stock, we continue to analyze it and regularly publish updates until we recommend that our followers sell their positions. Sell recommendations are relayed via email and phone message. This truly is a total investment solution for those investors with an income focus. If this sounds interesting, please call 1-800-VALUE-LINE for more information. This marks the end of the formal presentation, and I will now tackle your questions. Okay. First question is about ETFs, whether we offer an ETF product. Yes, we actually have 2. I'm using a subscription that doesn't have access to it, but as you can see, the ETF survey is right there. That is a robust screening offering where you can drill down to all the ETFs that are listed in the U.S. and Japan. It's well over 2,000. We also offer a product actually similar to dividend income and growth that I just talked about called Select ETFs, where each month we recommend a different ETF for purchase. And then each month we give updates on previous selections until we recommend a sale. So for someone who wants to build and maintain an ETF portfolio, that is what I would recommend. Okay. Next question. Okay. What determines whether or not a stock is moved to your VLAS group of stocks? Market cap? Question mark. Okay. The stocks that we add to VLAS, and of course we add stocks almost every single week, I personally choose them. And I look at the following criteria. Market cap is a big one. We try to add the largest companies that we don't currently cover. Just as important, however, though, is trading volume. The biggest stocks with the most heavily traded ones are the ones I focus on. I also look at their prospects, profitability, and other factors, but market cap and trading volume are the 2 most. I also take suggestions from subscribers if you want to send any my way. Next question is debt to equity considered in safety? Yes. For the financial strength part of the equation, a full balance sheet evaluation is considered. So we look at cash, we look at debt, debt to equity, etc. All right, someone's asking if there's a recording. Yes, this will be on our website and our YouTube channel within the next 48 hours. Okay, hold on. Questions are actually coming in pretty quick. All right. Once we have identified a stock we are thinking of purchasing, what is the best way to value whether a stock is cheap or expensive relative to itself? All right. Well, there's a whole host of valuation techniques. PE is obviously probably the most popular. I'd also recommend using cash flow and book value. A lot of that is actually covered on our reports, so I recommend that you check those out. Someone asked, what about Intel? I know Intel was one of the 7 stocks that was on our screen. Intel's prospects happen to be excellent. I think it's a worthwhile choice. After discussing with my analysts, we thought Verizon had a little bit better defensive properties, but there is certainly nothing wrong with Intel. And yes, it is highly rated across the board by a number of our proprietary ranks. One question asked about subscription prices. Unfortunately, I'm not the one to answer those. If you have questions about that, I suggest calling 1-800-VALUE-LINE, and you can speak to a sales associate. I apologize. I don't have that information. Okay. On the PDF reports, are the growth rates average per year or compounded annual growth rates? All right, so let's actually just go back to the PDF, and we can go over that. That's referring to the annual rates. They are compounded annually. However, just note that we use 3-year base periods compared to 3-year base periods. And you can see that specifically in the projections here. We find that it provides kind of a more accurate and more consistent reading, and it lessens the dependence on one outlier year. Someone's asking about the Alerts Hub. Yeah, that's something I didn't go over. We'll take a quick look at that. Under Find Ideas, the Alerts Hub will send you email or text messages when particular events happened. As you can see, I have a few set up. You can get an alert. We can actually do one out. Why not? You can get an alert when, for instance, we put out a new report, change of rank, or of course there's a notable price move. The question was about limits, and yes, there is a limit to how many people can set up. There are no limits for our higher level of subscriptions for more of our professional/institutional products. That is something that regular investors can subscribe to, so you might want to consider that. All right, let me see if there's any other questions. There's a question about the timeless ranks, more detail on the fundamental metrics. It is a proprietary, non-public calculation. I really can't say any more than what's in the ranking system guide, which I'll show you how to find. Under investment education, tools and guides, and there's the ranking system guide. And that's as much information as we can provide. Okay, that seems to be all the questions. Thank you so much for your time, and have a great day.